Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's Equity Analyst as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome to Different Makes a Difference. I'm Stephen Boland. It's early October as we record this episode. The NHL season is about to start. The Blue Jays are in the baseball playoffs, and I can only hope they're still playing when this episode goes to air. Now, there's an unlikely connection between the NHL and the Blue Jays, and that's Rogers Communications, the large phone service provider that also owns several sports franchises. Telecom is a big industry in Canada, and many of us own shares in Rogers or TELUS or BCE. So with us today to talk telecom, and perhaps a little bit of sports as well, is Cory O'Krainetz. Welcome, Cory.
Hi, Steve. Thanks for having me.
So let's start with an overview. What does the telecom industry in Canada look like, and why is it an area that investors should consider?
Well, first of all, yes, I am a big hockey fan, but I'm also cheering on the Jays. It's been a very exciting season, and it's great to see them back in the playoffs. I'll certainly be watching, and we can talk more sports later. But let's get into the telecom sector right now. As you mentioned, there's three big players, BCE, TELUS, and Rogers. There's also a few regional players as well, but most of the population is on one of the big three's networks. Those companies offer nationwide wireless, 5G networks, plus internet and TV. They often bundle these services to create value for customers, which leads to less turnover, stickier relationships, and these are essential services, as you mentioned. Over the past several years, they've built these world-class networks. 5G in particular, I think it's as good as anywhere in the world. And they have high-speed fiber to our homes. So we have screaming fast internet in our homes and in our businesses. And this is really no small feat. The big three have invested billions to make this all work. I think, when you consider Canada's population is essentially the same as California, it gives you a sense of just how much harder it is in Canada to make this work. Just the vast size of the country, the amount of ground you have to cover, there's mountains in the way, and there's waterways to contend with as well. But those investments have allowed the businesses to grow really nicely over the last 25 years, and they pay dividends as well. And those networks essentially act as a barrier to entry, make it tough for anybody to try and replicate what they have. So I would say, telecom, it's a good business. It's an oligopoly with three large players, but it's not an easy business. And certainly it's a difficult business to break into.
A lot of good points there. Certainly some attractive features to the industry, some tough parts as well. And the tough parts is what I want to focus on here now, because when I pull up a 10-year price chart of Canadian telecom stocks, it's not a great picture. They've underperformed the broader market pretty significantly. Why have these companies and their stocks not done so great over the last decade?
That's a fair question. And it might be surprising given how much everyone uses their devices and how much we depend on these services every day. Part of it is that the industry's matured and growth just has naturally slowed. I think the main reason is that there's been a price war. And, that's, the biggest driver of that has been government policy. During past elections, we've had promises to increase competition and lower phone bills. And ultimately, they succeeded. We live in an inflationary world, yet wireless phone costs are less today than they were 5 years ago. And I don't think anybody can argue that the connections are a lot faster and a lot better today than they were 5 years ago. The service is critical to our daily life. It is essential. We lose connectivity for a few minutes. I think panic sets in for most of us. And so this adds to the value proposition, but it's also a reason that the industry is regulated. In 2023, the regulators set rules at the direction of government that opened up network access for small regional players. They still need to negotiate a service fee, but they don't have to necessarily build a national network. So they can roam onto the incumbents' networks. And this has been a shift in the regulators' mindset. They, typically prioritized network investments. They had a focus on the quality of service rather than, just having lower prices. So there was a little bit more balance than there is today. And I think, in addition, the sale of Freedom Mobile from Rogers to Videotron, that was mandated as part of the Shaw deal. And that gave Videotron a platform to sell wireless across the country, gave them a brand nationally. And then they had a little help from the regulator as well. Another factor is that rapid immigration was akin to throwing gas on the fire. It created incentives to offer introductory style plans at really great prices so they could onboard these customers. And, the big three understandably wanted to protect their market share, and they offered very cheap plans by using their flanker brands. So that's Koodo and Public Mobile for TELUS, Virgin and Lucky, which is owned by BCE, Fido and Chatter, which is owned by Rogers. And this strategy hurt their profitability, but I think they succeeded in fending off competition, and they'll be stronger in the long run for it. Essentially, it was a grab market share at any cost mentality for the group.
Yeah, it definitely sounds like it's been tough for the companies. And it's interesting, I was cleaning out my filing cabinet at home recently, and I found a file that contained all my TELUS mobile phone bills from 15 or 20 years ago. I was actually blown away at how much more I was paying for my cell phone coverage back then. And you'll probably remember back then, you had a limited number of daytime minutes, you had your evening minutes, you had a little tiny bit of data, and it's just gotten so much better, yet the price has come down, which is quite remarkable. You kind of alluded to the fact that it could be getting better for the companies from here. Why is it going to get better for investors?
Yeah, I think we're nearing the end of the price war. These things tend to go through cycles. It's not the first time that we've had this. You may remember back in 2009 when Mobile was going to be the country's fourth national player, and that didn't end well for them. And we went back to more rational pricing. Nobody really wins during a price war, but the reality is that the smaller players, they lose more. And so it actually is better for the big guys in the long term. And this is especially true in Canada because of the sparse population, the diversity. It's hard to service the entire country. Ultimately, telecom's a scale business. There are fixed costs. Even if you can roam on the network, it's still an expensive business to operate. And I think the lesson we learned in the US is that even when you open the networks, it's tough and it's a hard business. So the focus seems to be shifting back to better service at higher prices instead of gaining market share. So I think slower immigration will definitely help that and create a little more price discipline. The thought of higher prices might upset some listeners, but we think, the value you get from your phone today and how important that connection is to you, could justify a higher price. My family went out for dinner at White Spot the other night, and it cost more than our monthly phone plans for all three of us. So I suspect most would be willing to pay a bit more for their phone plans, as long as the price increase is reasonable.
I think that's a great example, going out for dinner costing more than a monthly phone plan, which is quite remarkable and just speaks to how valuable this service is. It sounds like the industry is going to get better for all the big players here. You've got one of the big three in particular that you like the best, and that's Rogers. What do you like about Rogers?
So at Rogers, there's been quite a bit of management change over the past decade. I think this is the best version since Ted Rogers was there. Everyone now seems to be unified and pulling on the same rope, and that just hasn't been the case at certain points in their history. They also have the best networks. So they have the best 5G wireless network, and unlike TELUS and Bell, it isn't shared. It's their own network. They've led the way with it, and we think it's the best network that you can get in wireless. The Shaw deal is also a game changer, and that was a big factor for us. Now you can bundle that, industry-leading wireless service with their internet services out west as well. So it gives them the ability to create value for the customers and also grow the business. And again, it's a scale business. So, the more customers you have, the more cost savings there are. And, you can spread those fixed costs out over more customers. I think the benefits of the deal have also been masked by a tough pricing environment. And that's something that I think we'll start to see. They've actually had a lot of cost savings that have flowed through. But again, when there's pricing pressure, your margins don't really show that. So a little bit of pricing, I think, will go a long ways. The TV offering, I think, is also heading in the right direction. I know some people worry that that is a business in decline, but they're trying to be more of a content aggregator and gradually moving away from that traditional TV model. And so there will be some lost revenue from that. But the other side of it is that there's content costs that are over $1 billion. And so if they can get away from those costs, the business SWAT should be a lot more profitable. Having sports franchises, it's a bit scary. We can talk a bit more about that. But it is also a competitive advantage and can be packaged up with everything else. And I think it is a unique value proposition that they have.
I'd like to go into the sports a bit more, but first, when I look at Rogers, I see a lower dividend yield than BC or TELUS. Dividend yield's above 4%, which is still quite good, but some investors just want the highest yield. Given that, why do you still like Rogers better?
Well, in this case, we actually think investors are better off with the lower yield. Rogers pays out less of their available cash. So they have money left now to pay down debt, to make investments. So it's much more sustainable over the long term. And it's still a pretty good yield as well. If you look at BCE, they had a dividend payout that was unsustainable. It was over 100%, which ultimately led to a dividend cut. And I think a lot of frustration for income investors. TELUS has been issuing shares to help fund their dividend and their capital investments. So that just doesn't make sense to us. We like that Rogers is being more conservative, paying out less of their cash, and it helps them improve their balance sheet. If you look at their debt load, it's now in line with the peer group. They had to issue quite a bit of debt to make the Shaw deal, and they've now brought that back down, and their balance sheet's actually in a really good place.
Yeah, so there's a lot more than just the dividend yield. And like you say, above 4% is still a pretty good dividend. Let's look at sports. Rogers owns my favorite, the Blue Jays. They own the Toronto Maple Leafs, Toronto Raptors, CFL's Toronto Argonauts. I believe they own the football team, soccer team in Toronto as well. They own Sportsnet. They paid a lot of money, billions of dollars to own them. Does that make sense? Why does a telephone company own all these sports assets, and what's their strategy here?
Well, yeah, great question. They actually have a long history with sports franchises. So they got into the Jays back in the 2000s. The cost was about $160 million to own the entire franchise. That's now worth over $2 billion. So I would argue that's actually been a pretty good investment for them. The stadium they bought for $25 million back in 2004. That was back when it was the Sky Dome. So it's actually worked out very well for them. They've done some nice renos recently, and I think they've had a lot of positive feedback around that. More recently, you're absolutely right. They did pay BCE $4.7 billion to take over their 37.5% stake in MLSE. MLSE is the owner of the Leafs, the Raptors, and some other local Toronto sports franchises as well. And so this doubled their MLSE ownership to 75%. And, the key here is that it gave them control of the assets. The plan is now to take out Larry Tannenbaum, which will bring their ownership up to 100%. And this is going to happen at fair market value. There's a clause in their contract that they can buy them out by July at the latest. So it may happen earlier, but by July at the latest, they should have 100% ownership in MLSE. And yeah, the numbers are astronomical. But, I think there is a lot of value there. And where I gain comfort is that they can package both MLSE and the Blue Jays, bring them together and create a lot of value, I think, by doing that. There's certainly some synergies. And these are amazing franchises, some of the most valuable franchises in North America, not just Canada. And what they've done in Toronto, I think, is also really impressive. The city has almost been built around those two stadiums and those franchises. So I think definitely a lot of value. And as I mentioned earlier, their balance sheet's improved. And they're in a situation now where they don't have to worry about raising equity or doing anything like that to improve the balance sheet. They have it in a good place because they've been paying down their debt. So they can afford to be patient and wait to monetize it and get the best value they can. When you put it all together, there's some estimates that think it'll be worth at least 15, maybe even upwards of $20 billion for the entire package. That works out to at least $16 a share. And, there's a bit of a range there, but it could be even as high as $20 a share. So that's, we don't think, reflected in a $50 share price. We feel like there's some downside risk protection because it's not fully reflected. And if they can monetize it and execute on their plan, I think there's actually a lot of value there for investors.
So let's end by talking about Starlink. So Starlink is an offering of wireless phone service through satellite Elon Musk is the key individual behind it. Is Starlink a risk to Rogers and the other telecom companies?
So Starlink's a great product. I think, what they're doing is creating connections that just didn't exist before. But it's not cheap. I was actually up on the north coast of Vancouver Island during the summertime, and it is popular there. And it has been a game changer for a lot of the businesses up there that now have access to internet and cell service that they didn't have before. So it's interesting. Rogers has actually partnered with Starlink to provide service outside of their 5G network. So in these rural areas, it'll seamlessly transition over to a Starlink satellite and create that coverage that people typically lose when they get away from the main cities. So we think it can actually be a win-win. This is exclusive to Rogers. And I think it's an add-on to the plan that you have. So you don't have to do anything different. You can just work through Rogers. But I don't think Starlink is going to be a legit competitor in the big cities. I think it's too expensive. I think it's a better value proposition with the big three, quite frankly. But we like Rogers. But they have, I think, better value propositions. As I mentioned, that the phone plans are pretty cheap right now. If you go on Starlink, it'll cost you a lot more. And I don't think it would be any faster. If anything, it would be slower than a 5G network in a major city. So overall, I think it's positive for Rogers, and it could actually support their growth. And again, they're a leader in building out that network. So another reason that we like Rogers.
Well, it sounds like lots of good reasons to like Rogers. Thanks for being here today, Cory. Telecom's an essential industry, and it's an interesting space for investors. Certainly, the industry has had its challenges, but it seems to be coming out the other side. There are 3 big service providers in Canada, and Rogers is our favorite. It has the best network, there's cultural improvement underway, there's opportunities with Shaw, and it has some great sports franchises. And that should all make for a solid investment. So thank you, everyone, for listening. We hope you enjoyed this episode. If you did, please hit the like button and subscribe so you'll be notified of future episodes. Take care, and we look forward to talking again soon.
Thanks, Steve.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.